today. So without further ado, let me begin. Okay, so I'd like to introduce a little bit about us. Okay, we are part of a larger commodities research division within Refinitiv that was established in 2011, and collectively today we have over 150 analysts across all the commodity asset classes, being energy, of which oil is a major part of, agriculture, and metals. Each of us with a team of our own team of analysts. The oil research unit, today we have about 30 analysts in Singapore, Dubai, London, and Houston. And we produce what we call near-term in-depth analysis of supply-demand fundamentals for each product group by region. So for example, from the perspective of India, we are looking at crude coming into India. How much crude is India importing in real time? And what does that mean for the market, or the larger market? And obviously, we will need to benchmark our forecast against official numbers wherever possible. And I'm happy to say that we are generally above 90% for most of our Asian forecasts versus official numbers. For example, crude into China, we are 99 to 100%. For gas oil or diesel coming out of East Asia, we are 85%. And for naphtha coming into East Asia, we are 90%. Okay, so enough about us. Let's take a look at what I call the grim numbers, right? Today we have, as of today, we have 192,848, well, 192 million, almost 193 million infections. And there are over 4 million deaths in 211 countries. Okay, so what has this all done to the oil market? Well, prices went above $70, above $75 for over a month, amid returning global supply, but moves by OPEC Plus to raise output by 4.1 million barrels per day by December to a target of 37.3 million barrels per day, though it is still well below the pre-pandemic Q1 average of 41.46 million barrels per day. So ever since the announcement over the weekend, prices have sort of come off and we are at $69, $70, but in my opinion, it's still high. Demand has gradually returned, with the US and Europe in particular seeing a pickup in transportation fuels, leading to the peak summer demand season, which is now, while China has returned to pre-pandemic levels for over a year since last May. But continued lockdowns in India, Japan, and much of Southeast Asia continue to pose downside risks. Recent refining outages and turnarounds, both permanent in terms of refinery closures as well as short-term, such as what happened in the US during the deep freeze in February, has lifted refining margins for diesel, jet fuel, and gasoline, which have since recovered from post-pandemic lows when, if you remember, gasoline and jet kero margins fell into negative levels. Okay, let's look at it from a supply perspective. And when I say supply, it is a global picture. So output today by the world's largest producers have steadily risen to above 64 million barrels per day since November and up till May, from a post-pandemic low of 60.24 million barrels per day seen last June, though still well below the pre-pandemic Q1 average of 73.14 million barrels per day. This rise is led by OPEC and other OPEC Plus members as they restore output that was cut from last May, respectively at above 25 million barrels per day and above 13 million barrels per day since November, up from lows of 22.75 million barrels per day for OPEC and nearly 12 million barrels per day for the other members of OPEC Plus in June. Output from other major producers such as the US, Canada, Brazil, Mexico, Ecuador, and Qatar also rose from November, reaching the 24 million barrels per day mark. Right, if you look at OPEC Plus as a whole, they have agreed, as we know, to increase output by 400,000 barrels per day per month from August till December, bringing back a total of 2 million barrels per day of supplies and taking their total target output to 37.3 million barrels per day by the year end. The chart here shows the gradual increase over the months, the green ones being a forecast, a target output number, where the red ones being the actual numbers. At least 5 members, Saudi, UAE, Russia, Kuwait, and Iraq, will also see their output cut baselines increase from May 2022, bringing another 1.63 million barrels per day online by then. This is on the back of a restoration of 2.1 million barrels per day through May to July, of which 1 million barrels per day were added for Saudi Arabia and the remaining 1.1 million barrels per day shared among the rest of the membership. What about OPEC itself? OPEC alone, their output among the participating members of the output cut agreement have been at above 21 million barrels per day since last August. And this is despite the Saudis volunteering an extra 1 million barrels per day cuts from February till April that brought its output to an average of 8.17 million barrels per day for each month, close to the full compliance target of 8.13 million barrels per day. The Saudis restored output from May at 8.48 million barrels per day and 8.53 million barrels per day for June, with the full 1 million barrels per day to be brought back by this month, bringing its total target output to 9.13 million barrels per day. The wildcards are Iran and Libya, who are not participants of the output cut agreement, with their respective output today averaging at 2.45 million barrels per day and 1.15 million barrels per day from April to June. This is well above their Q1 averages. The other OPEC Plus members, such as Russia, Kazakhstan, Azerbaijan, and Oman, had their output raised to 13.6 million barrels per day since April till June, from a low of just under 12 million barrels per day. This rise is led by Russia, the world's second largest producer, whose output hit consecutive post-pandemic highs between April and June, averaging at almost 9.7 million barrels per day, rebounding very, very strongly from last June's 8.75 million barrels per day, but still under the Q1 average of 10.56 million barrels per day. And tellingly, Russia's output has already exceeded the 9.25 to 9.35 million barrels per day target that it was allowed to increase by for the period of February to May. And in terms of compliance, among the participating members of the output cut agreement, it has been high, averaging at almost 95% from when the cuts were imposed up till last month, and above 90% for every month since last June. Saudi Arabia, the UAE, Nigeria, Angola, and Azerbaijan were the most compliant, with levels at above 100% for May to March, while Russia and Kuwait were the least at under 90%. Even those that were far from meeting their commitments last May, such as Iraq, Kazakhstan, and Nigeria, have more than made up for it, cutting more than their monthly commitments to make up that difference. So a lot of them have cut by over 100% during this period. Right, what about what we call the non-OPEC Plus members, such as the US, Canada, etc.? Their output, in contrast, have actually remained fairly steady at 25 to 26 million barrels per day throughout the post-pandemic period, though under the pre-pandemic Q1 average of 28.73 million barrels per day. Output from the US, the world's largest producer, has held steady at 10.5 to 11 million barrels per day till June, but has steadily risen this month to a post-pandemic high of 11.4 million barrels per day last week, though this is still under their record high seen in Q1 2020 at an average of 13 million barrels per day. Output from Canada, the second largest producer in this group, rose to near pre-pandemic levels, averaging at 4.32 million barrels per day from November to April, though just under the Q1 2020 average of 4.39 barrels per day. Norwegian production has also followed suit, averaging at 1.77 million barrels per day and above the Q1 average of 1.71 million barrels per day, but came off in May at 1.65 million barrels per day. Okay, enough about supply. Let's look at demand, and demand meaning Asia. Unfortunately, this time around, we're going to look at it as Asia as a whole. We don't have time to break down into individual countries, but let's see what we have in Asia. Refinery runs for Asia's top 4 refining centers, being China, India, South Korea, and Japan, have risen above the 5-year average of 86.52% of the total nameplate capacity of about 27 million barrels per day since November, peaking at 91% for December to January, rebounding very strongly from April's 5-year low of 80.56%. However, runs have eased under 90% in the second quarter, culminating in May's 86.3%. This is the first time that runs have fallen under the 5-year average since last November. And this is curbed mainly by region-wide seasonal maintenance across Asia for all of the countries, as well as spiraling COVID infections in India and in Japan in particular. China is the only country with runs at above pre-pandemic levels, averaging at 91.1% between June 20 and May 21, despite undergoing its peak maintenance season in April to June. In contrast, runs in India fell under 90% in May on the back of a revival that started in November that saw it hit post-pandemic high of 100.8% in January. This is because of the massive wave of COVID-19 infections that saw daily cases surge above 400,000 barrels per day. But of course, you're better now. Runs in Japan have stayed below pre-pandemic levels of 89.8% throughout, seeing a very brief revival in November to January at 77.7% before falling to current levels of under 65% for May and June. Similarly, runs for Korea have also stayed below pre-pandemic levels of 97.6%, but it's beginning to see a revival with May levels at year high of 87.5%. And how has that translated into crude imports? Well, imports to all of the top 4 refining centers have rebounded steadily from last April's low, but remain under the 2019 average of 20.37 million barrels per day, averaging at 19.73 million barrels per day between April 2020 and June 21. And this is despite consistently massive imports by China for most of the past year. Imports saw a post-pandemic high of around 21 million barrels per day in February, but also 3-year lows at 18.5 million barrels per day in May. And again, we believe this is largely due to the peak seasonal maintenance across the region. China is the only country that imported above average volumes of crude, averaging at 11.3 million barrels per day between May 20 and actually June this year. But imports fell to an average of 9.9 million barrels per day in Q2, both on seasonal maintenance and a recent government clampdown on excessive production. So between May 20 to March 21, it's very high, way above record, and it's come off spectacularly since. In contrast, imports to India, Korea, and Japan remain largely at below average levels, some seeing a brief revival in the winter, but has remained curbed by still widespread lockdowns as a result of spiraling COVID-19 infections. In terms of yields, output for diesel and jet kero remain below 5-year average levels for the entire post-outbreak period up till May. Gasoline rose above the 5-year average level last October, but fell below that mark only once in February. We will see why as we go along. Diesel output averaged at 27.8 million tons per month post-outbreak, under the 5-year average of 30.3 million tons per month, briefly coming close once at 30.1 million metric tons last July, before staying under 29 million tons a month since. Gasoline production has averaged at 18.5 million tons per month between March 20 and May 21 versus the 5-year average of 18.8 million tons per month. So about the same. And it has actually rebounded above the 5-year average since last October, hitting a 15-month high of 20.4 million tons in March. Jet kero output, in contrast, stayed under the 5-year average of 9.35 million tons per month, again between last April and May this year, averaging at 7.24 million tons per month, but rebounded above 8 million tons per month in December to January due to a colder than usual winter. But it has since fallen again to under 7.5 million tons from Feb. Okay, in terms of percentage yields for all three products, they are all below 2019 levels, signaling that refiners are actually turning to non-traditional products to boost margins. Diesel remains the product with the highest yield, averaging at 29.2% between last April and this May, under the 2019 average of 30.8%, but have been under 30% since August. So refiners are not really trying very hard not to produce that much diesel. Gasoline yield, in contrast, averaged at 21.7% versus the 2019 average of 22.5%, and have been above 22% since August, showing a smaller output gap versus diesel. Jet kero yields are the lowest at a post-outbreak average of 7.6% between last April and this May, well below the 2019 average of 10.3%, and hitting a post-pandemic high of 8.3% this year. Okay, in terms of exports, for diesel and gasoline, both plunged in June after hitting peaks not seen since the start of the pandemic. So it went up last 2-3 months and then everything came off in June. Diesel exports, for example, fell to an 11-month low of 5.75 million tons in June, on the back of hitting an 11-month high of 8.4 million tons in March. And this is well below the 2019 average of 7.23 million tons per month. Gasoline exports similarly hit a 12-month low of 2.23 million tons per month, on the back of hitting a 12-month high of 3.7 million tons in March, and again well below the 2019 average of 3.12 million tons per month. Jet kero exports, in contrast, rebounded to 2.2 to 2.4 million tons for May and June, from under 2 million tons per month between July last year and February this year, though still under the 2019 average of 4.13 million tons per month. Okay, so what conclusions can we draw about the numbers that I have shown? Okay, for crude, okay, prices have come off recent highs of above $70 per barrel following the OPEC Plus supply boost. But demand optimism, particularly in the US and Europe, as the summer holiday kicks in and amid widespread vaccination rolls out there, will limit the downside. However, crude demand has yet to return to pre-pandemic levels in Asia, with India, Japan, and much of Southeast Asia still under lockdown, and with COVID-19 showing no signs of abating. Even for China, whose economy has returned to pre-pandemic levels, demand is expected to come off 2020's record high levels following a government clampdown on excessive production. The government has imposed punitive taxes on alternative feedstocks favored by private refiners who do not have crude import quotas, clamped down on the trading of these quotas, and issued lower quota volumes at 35.24 million tons for its tranche 2 allocations that just recently came out, versus last year's tranche 2 of 53.88 million tons. Recovering demand is balanced by controlled supply, particularly by OPEC Plus, which has managed supply tightly, keeping it well below pre-pandemic levels and amid high compliance to the agreed output cuts. The grouping has now agreed to raise output by 2 million barrels per day by December, adding 400,000 barrels per day each month from August. This is likely to cool prices and keep them at around current levels. Also, the US have kept output steady at 10.5 to 11 million barrels per day till June, but production has hit consecutive post-pandemic highs this month, culminating in 11.4 million barrels per day mid-July, amid the strong price environment and rising rig counts. So this is a signal, I believe, that the world's largest producer could once again take output back to its pre-pandemic highs of 13 million barrels per day. The high price environment can tempt producers into raising supplies beyond their target levels, as has been the case with Russia, which has seen its compliance fall below 85% since March, and with output at post-pandemic highs of around 9.7 million barrels per day between April and June. Iran's output has also risen to a post-sanction high of 2.4 to 2.5 million barrels per day for April to June, as talks on easing US sanctions continue, though production is still far below pre-sanction levels of 3.5 to 4 million barrels per day. Okay, in terms of inventories, overall inventories of middle and light distillates have come off highs we saw in Q1 as supplies tightened due to refinery turnarounds, closures of refining capacity in Asia, and reflected by lower stocks in the Singapore trading hub. Middle distillate stocks, for example, has fallen under 14 million barrels since mid-March, dropping even below the Q1 average of 11.3 million barrels in June, though still above the 2019 average of 11.13 million barrels. The latest is that it's around 11.2 for this week. Light distillates have also been on a downtrend since March, falling to under 15 million barrels and to steady levels versus the Q1 average of 13.4 million barrels per day and the 2019 average level of 12.7 million barrels, currently at between 11.5 to 14.5 million barrels. Okay, in terms of capacity loss, at least 500,000 barrels per day of regional capacity will be lost in the next 3 years due to full or partial permanent shutdowns, accelerated by the pandemic following a sharp drop in demand for refined products. For example, oil major Shell will cut capacity at its 500,000 barrels per day plant in Singapore by half in 2023 and fully shut another 110,000 barrels per day for the facility in the Philippines. Fellow major BP has shut its 146,000 barrels per day plant in Australia, Kwinana, in April. This is the country's largest refinery, and that's gone. Right? This has led to a jump for 4 million barrels of gas oil and gasoline imports per month. A fifth of total refining capacity in the US was shut down as the result of the harsh winter that we saw in February, and that has led to massive power failures and resulting in huge refining outages. And we're still feeling the effects of that now. The US is a major importer of gasoline, and the capacity loss has led to a surge in early April, the highest April value of imports for at least 15 years, and staying at post-shale highs of around 1 million barrels per day till this month. This is amid the peak summer driving demand season. These above average imports have kept gasoline inventories at steady levels versus the 2015 to 19 average of around 28 million tons per week as output gradually recovers. So in conclusion, for gas oil, the margins for 10 ppm gas oil, or what we call the crack to Dubai crude, has averaged above $8 a barrel since in July, strengthening steadily from $6 in March, amid tightening supplies, though still well below the 2019 average of $11.25 a barrel. Diesel's 48-month forward curve, as you can see, has flipped into backwardation of over $8 from a slight contango at the prompt end just a month ago. This reflects the product's strength. We believe this is mainly due to supply tightness during the March to June turnarounds, pandemic-led capacity shutdowns, and the clampdown in China. There remains downside risk, however, posed by widespread region-wide infections and returning output as time turnarounds end. For gasoline is even more impressive than gas oil. The cracks for gasoline to Brent has averaged at $8.44 for July so far. This is well above the 2019 average of $5 a barrel and the highest month average since May 2018. Reflecting the strength, gasoline's forward curve is in steep backwardation of over $17 a barrel from the current month to July 2023, signaling that the markets believe that the current bout of supply tightness will last. Gasoline strength far exceeds that of diesel and looks to be longer lasting, buoyed, we believe, mainly by the shortages in the US, the fall in exports from China, though the supply situation expected to improve as refineries return from shutdowns and when the US driving season ends in September. For jet kero, refining margins are not so impressive, though they have rebounded to a post-pandemic high of $6.15 for July, but still well below 2019's average of $14 a barrel. Jet kero's forward curve structure is flattish till December 2021, but as you can see, then flipping into a steep backwardation of about $6, then till the end of the 48-month structure from a fully contango curve just 4 months ago. We believe this is a signal of the market's expectation as to when aviation demand will come back, which we are already seeing pockets of demand revival in US and Europe. And with that, thank you very much, and I shall hand you back to Shafali.
Thank you, sir, for your research on current supply and demand insights about the oil industry across Asia. I now welcome our next guest, who is the Managing Director of Nagrika Exports Limited. He is actively involved in the industry, in the textile industry, and is the Vice Chairman of Cotton Textile Export Promotion Council, also known as TexPro-SIL. He is the driver of corporate strategy and leads the business development unit of Nagrika Exports Limited. I invite Mr. Sunil Patwari, Managing Director of Nagrika Exports Limited.
Thank you, Shafali. Good evening to everybody. It is my pleasure to share with you a few insights that I have on cotton, which is one of the commodities in the commodity matrix. I start with a small introduction on cotton. Cotton is known to mankind for a little over 7,000 years now. It is reportedly originated from India, moved to Mexico, and from there onwards to Europe and other parts of the world. It is one of the natural fibers. The other natural fibers in contention are wool and silk. Cotton, of course, is by far the most affordable and most friendly. So it's grown the maximum. Being an agricultural commodity, it is grown. Typically, it is planted in end of summer and is harvested in the early winter. It's more of a northern hemisphere crop, though of course Brazil and Australia and parts of Africa, South Africa, in the southern hemisphere also grow it. The crop takes typically 100 to 170 days to grow. Over time, there has been tremendous development in seeds, starting with the traditional seeds, then we had hybrid seeds, and then now we have these GMO seeds, which have increased the availability of the fiber and increase the yields for farmers and size of crop. Shivali, can I have this slide about the availability of cotton? Total availability of cotton from the slide you can see is about 26 million tons, the production of cotton in the world, of which India is the biggest grower with approximately 6.5 million tons a year. China comes next with over 6 million tons a year. Then US is the third largest grower. And then you have countries like Australia, Brazil, Pakistan, Western Africa, and Central Asia. That is the main suppliers of cotton. Some more attention on India. India has the largest area of cotton. We have about 35 to 37% of the world's acreage under cotton, though our output is less than 25% of the world's production. Meaning thereby that in India we have a scope to improve our yields. Presently, our average yields are around a little less than 500 kgs per acre against global average of about 750. There are countries and areas which are achieving a growth of more than 2,000 kgs, whereas in India we have areas with less than 300 kgs also. Within India itself, there is a vast range from the rain-fed areas of Maharashtra, where the yield is about 300 kilos, to irrigated tracts in northern Maharashtra and parts of Gujarat, where we have probably 1,500 kilos. And then northern India, Punjab, Haryana, again with vast irrigation, which are averaging around 800 to 900 kilos. So overall, there is a vast scope to catch up on the yields. Even while I say this, India has already achieved a huge growth in the crop size primarily through increase in area and improvement in seeds. Initially, traditional seeds were there. Then we had a phase when hybrid seeds came. That is in the in the late 80s and early 90s. And then the less than last decade, we have come to GMO seeds, which again increased our crop size by nearly 2.5 times. As we know, for apparel use and for home textile use, cotton is the preferred fiber. Amongst the natural fibers, that is wool and silk, and also in competition with the man-made fibers, which are viscose and polyester and nylon. Winter. If you will see this slide again, the consumption again has been staying close to the production of the crop, barring the exception of 2019-20 because of the pandemic. To clarify, the year here mentioned is the cotton year, which starts from 1st of August till 31st of July. So even in 1920, the pandemic effect is more visible. Post-pandemic, we are finding that consumption is already recovered and is projected to grow further in the next year. Since the production of the crop is not growing so much, this is directly having an impact on the inventory. So the carry forward stock is what is going to be reducing as consumption increases because the production remains about the same. A little bit more about the Indian crop. Like I said, Indian crop is approximately 6.5 million tons, which is about 37 million Indian bales. And this used to be below 10 million bales. And we have reached now 36, 37 million bales, primarily because of the switch to GMO seeds, which improved yields. But now there is a need and we are ready to go into the next phase of practices and improvements to increase the yield. As the experts would say, the scope of increase comes out of two main areas. One is the cropping practices, which include things like number of plants in a given area, the cropping pattern, then selection of seeds, which means the time taken to mature, time taken from planting to maturing. So given the local conditions in India of soil and weather and rains, there is need for us to match long duration seeds with and short duration seeds according to the areas. With these two factors, yields in India can improve significantly. Of course, there is again a scope to have better quality of seeds, which are more resistant to pests and weeds, that can again improve the yield. It's important to understand that more than 70 or 75% of the cotton grown in India is exported as raw cotton, as yarn, as unprocessed fabric, processed fabric, apparel, garments, and home textiles all put together. So cotton crop generates employment in the whole chain and leads to export earnings. And if we have more cotton available, our competitiveness and our ability to export will increase further. As of now, we are net exporters, but the quantity that we export varies from season to season. There are seasons when we have exported up to 6-7 million bales, Indian bales, like the current season. And there have also been seasons when we have imported cotton. For example, Indian cotton season of 1920, where we imported cotton because we had a smaller crop and consumption was driven by our export commitments. There is a small import of about 700 to 800,000 bales of extra long staple and contamination-free cottons, which are not available or not grown in India. So we have a steady import of around 7 to 800,000 bales a year. And as far as the export is concerned, in a bad year, we have probably a million or 1.5 million bales. And in a good year, probably 7 to 8 million bales also. The consumption of fiber in India. Before that, let me say that cotton has to compete with other fibers, primarily polyester, which is a man-made fiber from petroleum, which is cheaper in price compared to cotton and has properties which are more user-friendly in general in terms of longer life and easier maintenance. But as far if one talks about friendliness to skin and friendliness to human beings, then of course cotton wins hands down. So globally, if we see that the price-driven demand or price-driven consumption is dominated by polyester. So if we see globally, out of the total fiber consumption, polyester probably has a share of more than 60%, which is also true in India. If we see the consumption in the domestic market, synthetics is the dominant fiber and cotton is having a smaller share. But the total fiber availability in India is more for cotton. And like I said earlier, a large portion of this cotton fiber is used for export production and is exported out of the country. So the pricing of cotton in India needs to be export oriented or export driven, which means keeping export parity in mind, our prices need to be competitive and offer something on the table for Indian manufacturers to be able to produce and remain competitive in the world. For the users of the fiber in India is the textile industry, starting with the spinning. The cotton forms a very important cost factor and a very important raw material. In a spinner's revenue, approximately 60% on an average is allocated to raw material, that is raw cotton. As you go down the chain of fabric, garments, and home textiles, the percentages reduce but still remain a very significant portion. So For an Indian manufacturer of cotton textiles, cotton is a very important factor and presents a huge challenge in managing the risks of price, quality, and inventory. Traditionally, the prices have been governed and ruled by fundamentals, which would be area, the output, the weather, the timing, and that's how people have been taking their calls in the industry. But in the last decade and more, the futures have become an important factor, and cotton has evolved as a commodity with increased volumes of trade on the exchanges. Started first overseas, primarily by the New York Exchange, NYBOT, and ICE was the major measure of value for international cotton. In India, recently MCX has started in the last 7-8 years, and volumes are growing, and it is becoming a workable option. The industry needs to manage the risk of raw material, price, availability, quality, and inventory. So traditionally, people would time their purchases, buying more at the time when the arrivals are highest and buying less when the arrivals are lower. This is fine as it gives us quality protection, and in the traditional way, it gave price protection. But with the evolution of cotton as a commodity, the price movement has not remained as predictable as it was earlier. So this inventory now presents an inventory risk, which also needs to be managed. And as manufacturers, the challenge is that once the goods are procured physically and stored in your warehouse, if you need to change your direction, if you need to change your outlook, it's very difficult, because for a manufacturer to sell physical cotton is extremely difficult. So this increases the role of futures, and the industry is increasingly recognizing this. Both the users, the traders, the international traders, that is exporters of cotton, have started increasingly the use of futures. For example, if somebody has procured, let's say, 4 months of raw material on the exchange, and if the subsequent price movements necessitate a reversal of strategy on an exchange, it is easy to manage this. In physical cottons, this would be extremely difficult. And then when you are covering raw material, you deal with, of course, uncertainty of price, the fear of buying at the top, the possibility of passing on the price increases. So those are the fears. On a future market, the advantages are that you don't block all your money. You can manage the price risk, and the inventory risk is limited, and it can be managed better. So even though cotton is a fiber of choice for a large part of the consumers, for example, in the developed world, the usage of cotton is increasing. In the US, out of the total imports of garments, more than 50% is now consisting of cotton garments, which is good for the fiber. For the industry, major risks remain about the price movements, because the ability to pass on price increases is not directly related. There is a lag and sometimes big mismatches. So pricing or managing the price risk on cotton is even more critical. And in addition to the traditional management of based on fundamentals, there is a need to use the futures, which are now available and which offer a very, very good possibility of hedging our risk. There is now more data available on this. There is advice available on this. There are experts who are undertaking and studying the movements and are able to guide us. We have to recognize that the price movement of cotton as a commodity is more than just fundamentals of cotton. Also, the fundamentals of the commodity space, the money markets, the stock exchanges, the equities, everything has now a bearing on cotton. And all these need to be managed. It's not a matter of choice. If we are in the business, we have to maintain, we have to take care of it, and it is our onus to manage it. I have tried to cover this based on from my experience. Cotton, of course, traditionally prices have been going up. I remember in 1985 purchasing cotton at 2,700 rupees per candy, which is the measure in the Indian market, to 72,000 in 2011-12. In the current year, we have already crossed 55,000 rupees a candy. So that's the kind of movement. Even from 72,000 in 2012, sorry, we saw a fall to below 35,000. And then from there, it's been growing. One of the reasons for growth is the increase in the farm prices to protect the farmers, to compensate them for the increase in cost of growing cotton, increasing prices of inputs. So prices will go up, but unfortunately, it's not linear. We cannot predict it and live by a prediction. We have to be prepared for volatility, which we are seeing in ample abundance. Again, the current season of cotton is a good example. India started the season with a huge carryover because last year, because of pandemic, the consumption was less, and we started with a huge carry forward. And now, when in the month of July, another 2.5 months to the arrival of new crop, we already seem to have exhausted all our stocks. So this shows how the commodity can behave differently or not exactly in line with our expectations. So the need to manage risk is great. Futures are a good tool. Industry has started using it. And of course, we look forward to inputs from experts on better use of this. So I will end with my presentation that we need to be aware of the risks of cotton pricing as it is with all commodities and be prepared to manage it. Thank you. Shefali.
Thank you, Sunil sir, for sharing your valuable knowledge on the fundamentals of cotton pricing, right from its production to its consumption. Exports. We are now headed into our session of soybean by our two veterans of the industry. The first panelist for the session is Mr. Amrendra Mishra, who is working with ADM, also known as Archer Daniels Midland Agro Industries India Private Limited, for more than a decade. He has held several roles including trading, risk management, and commercial management in India and the United States. He is also an active member of various industry bodies. He is on the executive committee of India Vegetable Oil Processors Association and a member of the Soybean Processors Association of India. Our second speaker for the soybean session is Mr. Vaibhav Rajput, Head of Soft Oils Trading and Risk Management, Kargil, India. He has an experience of working with the ABCDs of agri. He is at the forefront to tackle this volatile market at Kargil, India. A successful trader and a risk manager of soft oils for the last 10 years. Alumni of Delhi School of Economics with masters in international business. He has also completed a certified competitive strategy program from the University of Chicago Booth School of Business. Please welcome both our panelists, Mr. Amrendra Mishra, Managing Director, Oilseeds, ADM Agro Industries, and Mr. Vaibhav Rajput, Head of Soft Oils Trading and Risk Management, Cargill India. Thank you.
Mr. Amrita Mishra to start, begin.
Okay, someone can share my presentation?
We'll make you the presenter, sir. Give me a moment, please. Amrin, sir, you are the presenter now.
Okay.
You can share your PPT.
Please let me know if you can see this and then I can proceed.
Yes, we can see your presentation, sir.
Okay, then. So first of all, thank you for inviting me this on this webinar, and I really like this opportunity to speak about oil seeds and soybean in particular. And it was nice to hear about the crude oil markets and cotton markets from the panelists before me. So thanks a lot to both of them for sharing their insights. Now, I will start talking about the situation, what we are going in the global oil seeds, and then particularly about US soybeans, and then touch base upon India, that how we are seeing the situation. As a disclaimer, I'm using the data from USDA, AgriCoop, Government of India, Business Line, and SOPA. So this is for the reference. Now, starting with the global demand and supply of overall oil seeds. As we saw in the latest report from USDA, the USDA has increased the production in the global oil seeds. We are talking a production increase of 6% versus the last year. So they are expecting an increase on sunflower in the Russian areas, as well as slight increase in the Black Sea, and then slight increase in the rapeseed, cottonseed, and peanut production. However, they have reduced their estimates on the soybean crop in the US. So with the increase in the production, the overall usage or consumption is also expected to increase. The consumption is expected to increase by 3.5%, and hence we are seeing a slightly bump up in the ending stocks of the global oil seeds. However, if you see the increase in the production, but the comparative increase in the closing stock is not that significant, which is creating a situation where the growing regions of the world, they are heavily dependent on the weather situation going forward, and they need to produce around their trend line yields, so that overall we are able to maintain proper supply in the global oil seeds market, because the ending stocks are still not at comfortable level. They're slightly high versus last year, but if you look at from compared to 2019, the ending stocks are still lower, despite the increase in the production. So that tells you the tightness in the demand and supply, which is reflecting in the global oil seeds market. On the oil meals, if we look at the numbers, then this situation is looking fairly, I would say, a bit comfortable. Overall, we are seeing an increase in the, it is expected that the crushing will increase across the geographies. Also, with the normal increase in the protein consumption across the world, the ending stocks are still at, on a year-on-year basis, slightly higher or better. So the oil meals look at from a global perspective, they look at a comfortable position, but the story on the vegetable oils becomes a bit tricky. So as we are seeing that despite the increase in the production of overall oil seeds, increase in the crush volumes across the regions, despite that, the oil stocks are expected to go down. And we'll dwell further into this, that how USDA is looking into into the different geographies and especially US. But this is something which oil market is realizing quickly, and the overall spreads which are prevailing in the world market are already indicating the tightness which the trading community is seeing in the veg oil markets across the world. Now moving ahead, looking more deeply into the United States soybeans supply and demand scenario. So this is as you all know that US is one of the biggest producer of the soybeans. Recently, Brazil have overtaken them, but US remains a key market driver for the global soybean as well as the overall oilseeds market situation. So looking at the US crop is very important, because that decides the trend for the South American crops as well. So if we look at the latest projections which USDA has come out, they have kept the yield same as that of their previous report. They've slightly increased it versus the last year. The US production is expected to go up by 6%, and they are projecting crush to be up by 2.5%. And because the South America is taking more share of the export demand, hence they expect the US exports to be slightly down. And putting all this into perspective, despite higher increase in the production, is still the US ending stocks are again pretty close to what we see what we saw this year. So there is a slight increase in the ending stocks by 20 million bushels, but in terms of what we have seen previously, these ending stocks are still tighter. So and that's why we see that a tremendous focus is being put on the US weather and the volatility on CBOT beans, where the market is swinging from one direction to another with the projection of the rains in the Midwest. Now moving ahead with the US soybean oil situation. So the renewable fuel standards and low carbon fuel standards in the state of California, and primarily known as the green new diesel, has been a game changer for the US soybean oil. And as we understand the geography, most of the green diesel manufacturer, they are on the west coast, on the western side of the US, and then this oil needs to move from the Midwest to the US. So there is a logistical constraints, there is a capacity constraints, and hence we saw that CBOT oil broke its trend on a long-term basis, and we were able to see the prices one of the highest prices last seen in 2008. So it was a spectacular rally, a secular rally, we'll call that, how these prices continue to move in a single direction and broke its correlation with other parts of the world, because this was driven by the domestic US policy of renewable diesel and green diesel. And then if we look closely to the supply demand scenario which USDA is projecting for this year, again we are seeing the ending stocks on the soybean oil is getting tightened further, and this is despite USDA increasing the imports of soybean oil. This is despite the domestic crush going up. Still, because of the consumption on the biofuels and green diesel, the US oil stocks continue to remain tight. And this again puts more emphasis on why do we need a good weather and good US crop in order to meet the growing requirement of soybean oil in the United States. And then looking at the US soybean meal S&D, I would say this looks fairly balanced. This looks fairly fairly okay. We have a normal year-on-year growth in the consumption on the supply side as well as on the demand side. So there is slightly uptick on the stocks, but compared to say soybean seeds or soybean oil, this looks a bit dull or not that exciting. So moving ahead and coming to India. So as we all know that we are in the middle of our planting season, and so far we started with a projection of a normal to better monsoons, and it did started on time. I would say a bit slightly late, but the initial coverage of the monsoons was good, and it was raising a hope of another bumper agriculture production in India. However, what we saw that from the third week of June, monsoon took a break from most part of at least from the central and northwestern part of the country. And then we had very scattered or erratic rainfall for the last 1 month. In the last week, we have seen some improvement on the rainfall in the key oilseeds growing area in India, and which is a very good news. But overall, it is still it's still like everyone remains focused on how the monsoon will progress further, because that will determine the fate of the oilseeds crop in India. So looking at overall oilseeds, if we see from a normal planting standpoint, we are still fairly average to the normal plantings. But if we compare to last year, the oilseeds area is lagging. But last year was still, we were fortunate that the rainfall was on time, and it was properly distributed, so plantings could happen very fast in a fast manner. And also compared to the second wave of COVID, the first wave was less impactful. Hence, farmers had more time to speed up the plantings early. Then talking specifically about soybean, we are seeing the plantings delayed and a 12% shortfall in the area compared to last year. And as we saw that the monsoon has slightly recovering in the last week. So let us see that how this gap in area has been fulfilled. And then as we have subsequent reports from the government, this trend would be closely followed. Moving ahead in terms of state-wise, if we see, then the coverage, we are seeing that last year we closed at close to 11.8 million hectares. This year, the last government reported at 9.3. However, the industry body SOPA, which has done a tremendous work in terms of getting an assessment of the soybean crop in different states of the country. So they have come up with their estimate of 10.4, and they remain hopeful that that overall we may see a 5% increase in the area, slightly less in MP and then higher in Maharashtra. So the situation is still, as the crop is in development phase, and certain areas where the plantings are still to catch up will remain under watch. And if the monsoon conditions improve from here, from the central parts of the country, then soybean crop can definitely recover a lot. Then this is just further to the rainfall. As you all can see, the key oilseeds growing area is under moisture deficit till as per the latest report by IMD, and we see the overall departures in the central India at 8%, and then so far country as a whole we are seeing a deficit of 5%, which is close to normal. And then the areas in the southern peninsula have been benefited by better rain. So that is a sort of consolation for overall monsoon activity this year. And then finally, I think the next, say, one to 2 months will be primarily driven by the weather. The US crop will be entering its critical phase start of August. So we can see a lot of volatility on that side. The Indian crop will also be closely watched with the progress of the monsoon. Then we have the sunflower crop getting to maturity in the Black Sea area. And then we will start hearing about the planting weather in Brazil. So the next 2 months, 2 to 3 months is going to keep us occupied with the weather situation, and then this looks to spiking in the volatility on the overall situation. So it has to be closely watched out for, and hence and in times like these, when we are seeing increase in volatility, when there is more decision is to be made in terms of how do we manage the position. I think the overall the role of risk management is very important here, and we need to, for all those who are participating in these markets, it is advisable that that you keep a proper track of your positions and also use exchange-based products to hedge your risk. I am very happy to see that NSE is developing this product of crude become soybean oil. India remains a key importer on the soybean oil, and hence this product gives a great platform for the importers and traders and refiners to hedge their risk appropriately. So this is one of the risk mitigation strategy which the oilseeds community can use. So with that, I would like to close down my presentation. I thank you again to all of you for patiently hearing to me, and over to you, Kundan. Thank you.
Yeah, Mr. Vaibhav, over to you.
Yeah, sure. Just let me know if I'm audible.
Yeah, you're audible.
All right. Thank you so much, and good evening to everyone. The one thing what I can see in common, sorry I joined a bit late, but last 30-35 minutes, everyone is talking about a lot of volatility. And one thing is for sure, the markets are highly correlated, whether it's a financial markets, commodities market related to financial markets, or the government policies. So let me start with saying a thank you to NSE, Almus, and Refinitiv for providing me this opportunity to come here and speak in this webinar. I know it has been quite a tough year, especially last 3-4 months due to this COVID variant having a higher mortality. I wish and hope that we don't see this kind of environment again, and we go back to being normal. And being normal means being a happy and a good times again back in this world. So what did we learn in this time of darkness? That the new jargons and the old jargons come to resurface. The old jargons like super cycle, bull market, easy money, and the new jargons with a lot of interest was a Wall Street bets or Doji coins. And to the best of all of us is the Elon Musk tweets. That has also started redefining the markets. May not be directly on the commodity side, but yes, overall on the financial market side. On this time of darkness, I also see a very good thing that is happening. There's a lot of retail participation is happening in this country. So it has been more dependent or more weighing on the financial markets, but to some extent, it has also done a good job in commodities market as well. So sharing an anecdote, I was just driving to airport a few days back, and I had a driver in Ola. He was asking me, he overheard me speaking on some market, and he told me that he has heard about share market and there's a quick return over there, how he can invest. So good or bad, it might sound a bit funny, or it may become a reason for laughing, but that's not the point. The point is that at least some kind of awareness on economics or finance, there is something developing, and a more risk-taking attitude or approach is developing in the country. And there's something good to see, and that one of the blessings of this pandemic, the only good things of the pandemic that has surfaced is that good retail participation. A lot of media attention has grabbed on the crude oil market, which is petrol and diesel. But I think the edible oil market, the vegetable oil market also saw some action with a lot of news grabbing the attention in the last few weeks or so that the prices has doubled. So I'll in the next few minutes, I'll divide the speech into two parts. First is what led this market to be almost double. Just remember one thing, whatever happens in the global market, India is the derivative of the origin cash market. So India generally follows a multiplication factor of 1.385 on the soft oil sides being a duty impact. And on the palm, it's about 30% higher. So important to see how does India got impacted during this last few weeks, and also what happened in the origin market and what does it look like in the next few weeks. Important to start with an old proverb which says there is nothing certain but uncertain. So going back to school, my professor and my mentor at University of Chicago Booth School of Business, he said, we live in a VUCA world. What does VUCA stands for? It's a volatility, uncertainty, complexity, and ambiguousness. Nothing is clear. I mean, you hear the new variant coming in, which is more deadly, or the government policies. The world has seen a good correlation, but I think a big round of thanks or applause for all the scientists who has helped us in overcoming this hurdle to some extent. Now, this is not I was listening to Mr. Patavri over here, and he rightly mentioned it is not anymore a game of a simple demand and supply fundamentals. There are a lot of many other factors which are coming to the fore. And especially with its new government taking place in US, the climate has also come into the picture. So now what are the other factors in spite of just mere demand and supply is the government policies, what you are going to look at related to climate, the climate issues, the fund play, the easy money, what we call, where the easy money is going. In other parlance, it is also called managed money. And the world is getting highly correlated. So if you have any kind of a repercussions happening in the financial market, you see a somewhat certain repercussions in the veg oil market as such. So what happened in the soybean and the soybean complex? I would say soybean, meal, and oil. Last few years were the years of trade conflict. We saw a trade conflict coming to the fore. The world was reeling, especially China was reeling under the impact of African swine fever. And then it happened, COVID, and we saw this market continue to remain subdued. What happened in the last last year, I would say, the restocking happening, the economy started opening, especially on China side, and a big China demand came into play. What led the prices, what we saw, almost double versus last year. And India, as I mentioned, it has a duty impact. Was a couple of factors. As everyone mentioned about the weather, we had one of the worst weather, stressful weather in Black Sea last year. We saw a reduction in crop in sunflower seed in Russia and Ukraine. We saw strikes in Argentina. Debt issues in Argentina will continue to remain a problem. They have settled to somewhat in the last few days or so, but it continues to remain play. And obviously, slower than expected production in palm oil. And with economies opening up after the wave one, we saw a good round of demand coming through. And these are the major factors that led this a unidirectional market, a market which was only going to the upside. So what now? What is happening now? I think as Mr. Amrita mentioned, world is still reeling under the stressful weather. So this is the time, this is a period in this part of the year where the Northern Hemisphere plays a very crucial and a very important role in determining the course of action in the vegetable oil market. This is because there are many regions in the world which grow soybean, rapeseed, and canola and sunflower oil. So today, as we see, we are in a scenario which looks a bit unbalanced because of the last repercussions of the last year. The US is facing a stressful weather now, especially in the Midwest. The Canadian weather is also getting stressful. We have still a very decent weather in Black Sea and India, as I mentioned. We are seeing again almost 20%, especially on the western part of Maharashtra, Madhya Pradesh, and also on the eastern part of the Madhya Pradesh is almost 20% below the normal what we are looking at the weather. So important to look at this vegetable oil market is to figure out the pattern of weather. There has been a lot of discussion. We recently saw there were massive floods in Germany, parts of Austria, and France as well. And why to go so far forward? And we also look at India. We had so many tropical storms. We had typhoons, Taute, Yas, etc., etc. I'm not particularly an expert out here, but the weather is playing a major role, and especially it has a major emphasis, a major weighing on the vegetable oil prices in an unbalanced demand and supply here. So what is happening? The world is gradually going away slowly, I would say, from the current fossil fuel regime. There has been a great capacity expansions in US for the biodiesel, for the renewable diesel, which is also called a green diesel, and they have some kind of incentives around. So the US government has a agency called US Environmental Protection Agency, which runs a renewable fuel standard program. This is a national policy that requires a certain volume of renewable fuel to replace or reduce the quantity of petroleum-based or transportation fuel or jet fuel. So the obligated parties are supposed to blend this and get the credit, which is called RINs. If they don't do it, then you have to buy the RINs. So as Mr. Amrita was showing you the balance sheet, we had the recent WASDE, the World Agriculture Supply and Demand. It projected a very important thing that in last year, until last year, the biodiesel, soybean as a feedstock, as an input stock to biodiesel, which was about 35% of the total production in US, has now increased to about 45%. So that market has a lot of bearing, and how does the crude oil market, how does the blending margin, how does the producer's margin takes place, and that will determine the course of market, especially CBOT. So we have to understand the importance there, and it's going to be the new future in the nearby. So what will decide that market? I think these are the few important things. We have the Environmental Protection Agency coming out with a certain sort of a renewable volume program. It's a program which states the amount of quantity to be blended, as I mentioned on in the fuel, in the diesel transportation fuel, and this becomes very crucial to determine how is the soybean oil market, especially on the US, is going to behave. And as I mentioned, US weather is something to look out for. Today, the Midwest is facing heat, and if we go by what if we go by the secondary market research, we see about 30% of the market is feeling some kind of a soybean market, is seeing some kind of a stress out there. So these are going to be the important factor in the green oil market in the next few weeks, and it's going to be one of the major action point we are going to see in next few weeks. What happens? Soybean oil is also composite of the premiums. Premiums are a function of two things: A, the European SME demand, which is basically soya methyl ester, again part of the biodiesel story, and how they are going to, and also upon how does India is going to behave on the demand side. That's going to determine what will be the course of action and how does the market will behave on this. Important to look out for today, it's just the 2 points, that is India plays a very pivotal role in how does the demand and how does the premium market behaves in Argentina, Brazil, as India is almost 40-45% importer of the total exports of these countries. Important to look out how does the delta variant spreads out in Europe. There has been a bit of a concerns coming forth in the last few weeks, what we have heard, and how does the opening up happens in this country. after the second or third wave, or if the virus is going to mutate further, how does the opening up happen? Important to look at the mobility factors, which will determine what will be the demand going forth in the next few weeks. Coming back to India, we saw one of the worst months, I would say, in months of May and June, with almost 60% of the country was under lockdown. We see a bit of a beating on the demand side, especially HoReCa, which stands for hotel, restaurants, and cafes. They were closed. People were a bit scared to venture out. We saw demand tapering off. The only different thing what we saw last year in lockdown and this year, that the general public did not have a fear that they need to stock up commodities, they need to stock up oil. They were somehow assured, that the availability of oil will not be a question, and they continue to remain hand in mouth. So it will remain very, very important in India to see if the predictions, whether this the next COVID variant or the third wave, or if the virus mutate further, if again is going to be locked down, these are going to be very crucial things which will decide the course of action in India market, and especially on the demand side. As weather has continued to remain in concern, I think, as I mentioned in my discussion earlier, about 20% of below normal, the spread of rains has been not great. India is seeing about Western Madhya Pradesh, Eastern Madhya Pradesh, seeing about 20% or so lower rainfalls than normal. So it's going to be important, and especially it's important in the northern hemisphere, as I mentioned. How does the crop shapes up, given we have stress in initial part of the month? So August will continue to remain crucial, whether it is US, Black Sea, or India. And the next, when the sowing happens in South America, which is in Brazil and Argentina in the months of October and November, those are going to be the another crucial months going forth. So in short term, I would say the market will continue to remain volatile. We have few things, as I mentioned, crops are still getting produced in US, India, Canada, Black Sea. A lot of action is coming, has to come from the EPA. Which everyone would have heard in the last 2 days that has been delayed. So the government policies regarding this biodiesel will decide the course of action in the market, and these are the few important things to really weigh on for. Volatility will be the name of the game this year as well. It's not going to be easy in an unbalanced supply and demand scenario. I think it will be very prudent for all of us and to weigh in and more and explore various risk management tools. And NSE provides one of the better tools to be a long hedge or short hedge. Long hedge in all those people who are watching or listening here, for those old people where vegetable oil comes as an ingredient, whether it goes for biscuits, cookies, nuts, or for soap, or any other thing, and for those producers or refiners to have some kind of a good risk management in place to weather this volatility which we are going to see in the next few weeks or so. With that, I'll end my thoughts out here. The only thing which I want to say, it's important to be healthy. It's important to be safe. And I had one line from Thomas Carlyle, which said, "He who has health has hope, and one who has hope has everything." So stay healthy, stay happy, and God bless. Thank you so much.
Thank you, Rajput, and thank you, Mishra, for educating us on soybean, which is a bit new to me. And we have a question, two questions to Yon Chang. Yon, are you there?
Yeah, I'm here. I'm here.
Yeah, I posted it. Would you like to read
Yeah.
out?
Okay, yes. So it's given. Sorry, let me read it.
Yeah, one of the question is that your view on
Okay.
sugar oil, given the environment concern by the new government, with the production returning to the previous level, with demand pickup. The second question is that the investment on green energy going up. How do you see oil market prices behaving from now to 2035? Is the same kind of volatility will continue or a bit of stable market in oil?
Okay. Basically, the first thing is in terms of environmental concern, I mean, globally, there's a move towards a greener future, right? And the pandemic has accelerated that move. We have seen oil majors, particularly Shell, BP, have saying that they want to reinvent themselves as a green energy company. And they have matched those words with action with Shell, as I said earlier, taking down half of their refining capacity in their plant here in Singapore. And that plant here in Singapore is the largest in the world. So yes, they are serious in doing that. Right? So I believe you would see that going forward. But at the same time, in terms of demand, right, it's in terms of near-term demand, it would be still led by, how are we recovering from the pandemic, how are countries coming back to normal, etc. Right? And that, if you look at the last three charts that I put out in terms of the forward curves, it shows you that the world believes that it will come back to normal in 2022, particularly when aviation returns to normal. So you would see, I would expect to see an uptick in demand, particularly from this region, as today Asia is still quite severely under lockdown, right? So by 2020, hopefully, we'll all come back to normal and, it's business as usual. And obviously then demand will return. Don't forget, even with the OPEC plus supply boost from August to December, supply is also not at pre-pandemic levels, right? So the two has to come together. Demand has to come back slowly, and supply will slowly come back as well, right? That's the first question. Second question, I mean, I'm thinking the world is moving, say, from 2030, 9 years from today, most of the countries say that they will start moving into electric cars, etc. So obviously that would certainly lead to a drop in demand for transportation fuels, right? And by that time, I would think that refineries would have to find a new use for transportation. What is today their biggest selling product, which is transportation fuels. And if we take a leaf from what we see the new refiners in China are doing, right? They are building their refineries with a large petrochemical production component. So today, the three big refiners in China, the three new big refiners in China, all private at 400,000 to 800,000 barrels per day, are having petrochemicals as their main product at 50% or above of the yield. So today they don't care about diesel, they don't care about gasoline anymore. They only care about petrochemical. And that would then continue to lead to downstream demand for crude. I hope that answers the question. Back to you.
So you're on mute. Can you please unmute yourself?
Sorry.
Yes.
Yeah. Okay. Thank you all. The next question is to Sunil sir. The question is that can Indian company hedge cotton risk on international market? What is more ideal hedge, local exchange or the international market? And also I can add here how challenging and how is it make sense or is it difficult to operate considering the cost or regulatory clearance, etc. Sunil sir, you have to unmute and speak.
Thank you. The first part of the question seems to be whether we can hedge the price risk on the international exchange. Yes, it is possible, subject to certain regulatory compliances, and we have to use those channels and for example, the market operators who can facilitate that. The Indian option of hedging on MCX is also decently good. It has picked up volumes and there is depth, and it has been found to be reasonably good. So you can cover on the Indian exchange also. International, of course, comes with a lot of compliances and more restrictions. Does that answer the question, or is there something more?
Yes, it answers the questions. The second question. No, I have not asked the second question to you. See, how is this currency impact on Indian exporters compared to our competitors, maybe China, Bangladesh, and Pakistan? I believe the Pakistan and Bangladesh currencies are depreciated much more than Indian currencies. This is what we hear. How is it? Even labor may be cheaper there.
Of course, you're right. Indian rupee is turned out stronger than both Pakistani and Bangladeshi rupees. And traditionally, as exporters, the weak domestic currency always helps us to compete better on export markets. But in our experience, we have not faced too many hurdles with the relative strength of the Bangladeshi or Pakistani currencies. We have faced more hurdles from the fact that their cost of production is lower, and even greater is the impact of they having preferential access to overseas markets like EU and USA, preferential in the sense of duty preferences. For example, Bangladesh and Pakistan have duty-free access to EU in many categories. So there we have Indian exporters face a greater difficulty.
Thank you, Sunil sir. Now the question is to both Amarinder Mishra and Vaibhav. I believe this product CDSO, which was launched by NSE lately, is known as a very hot product, and it may be a good opportunity to make money. Why it is so hot? Amarinder Mishra and Vaibhav, this is a question I would like to get answer from both of you.
Okay, I'll say as Vaibhav is expert in oil, I'll let him go first on this and then I'll take it later.
Okay, Vaibhav.
I guess Mr. Vaibhav Rajput, you need to unmute yourself.
Yeah, sorry. So I think that's a good, a very unique question. Why is it so hot? The entire commodity market is hot, whether it is copper or edible oil or gold, everything is hot. So, so this contract, how can it be left untouched? I think important to understand for us is to have a good correlations in the market, so that the real sense of hedging makes sense. You buy something and you hedge it and it does not have a good correlation, then the hedging doesn't make any kind of a sense. So a good correlated hedge, whether you are a producer or refiner or a commodity player, or as a commodity ingredient player, it is always important, so that when you buy physical and when you sell the futures, that should be reflective. I mean, you don't get stuck on the basis risk, illiquidity risk, or any kind of a default risk, and that's might be the reason why it's hot.
And
yeah,
building on Vaibhav's point, I think one of the most important thing is the credibility of the platform. I think NSE in its expertise on the equity markets and one of the biggest exchange in India, they have proved that they have got that platform, and I think the safeguard of the participants on the contract, like, because we need a wider participation for a proper discovery, and hence once we have the wider participation and everyone feels safe on hedging the platform, I mean the contract will have all the ingredients to become hot. So I think the system which NSE is developing, I mean, for the future, this is going to be one of the hottest commodity to trade on the Indian exchange. And I want to wish them all the best for this.
Yeah.
Thank you.
Yeah. Thank you, sir, for that question, answer of that question. I would like to conclude. We are already extended by almost 19 minutes. Thank you again, Mr. Yan Chan, Mr. Sunil Patwari, MD of Nagarika Exports, Mr. Amrinder Mishra, and Mr. Vaibhav Rajput. And it's so nice of you. I thank all the participants who are still there, over 80, even after we are extension of 19 minutes. And the thing is to know those of you who are still there and those of is to the market is that commodity is a really hot. What I understand it is even our technicals works very well in commodity, and it is a bit easier. I think Vaibhav will agree with me to make money in commodity rather than currencies and equities, which has been more liquid. And I liked your sharing of your Ola driver telling that, sir, I would like to invest in equities. See, I've been in the market, and what I am hearing, I am very optimistic and very bullish on Indian markets, Indian total financial markets, because many things had to come to Indian market, and it is definitely going to come. You know, the kind of rupee being traded overseas, rupee for all practical purposes is convertible. So there are so many products are coming, commodity markets are developing, equity markets are developing. With the low interest rates, we have no other go other than focusing on the financial products and manage, and the pension schemes also going away, fixed pension schemes. So it is for each and everyone to focus on all the market, all the asset classes. With this, I once again thank all of you for your participation, or for the panelists. Thank you again. With this positive note, I am ending this meeting.
Thank you.
Thank you.
Thank
Thank you so much.
Bye. Bye.